each individual stock is, or a stock portfolio is, or any financial instruments, how to measure the risk and how to analyze the risk-return trade-off. And remember, our ultimate goal in these three chapters, chapter 12, 13, and 14, the most important goal is to find the right discount rate for a risky investment. Why do we need to find the right discount rate? Because this is a corporate finance class. We need to evaluate corporations' investments and to evaluate new projects. We need the discount rate to find the present value of expected future cash flows from that investment. So for example, NPV calculations need the discount rate. And chapter 12, 13, and 14 teaches you how to find the right discount rate. So that's why we take a look at historical performance of risky investments to get an idea of how to find the right discount rate for risky investments. All right, so let's move on. So there are this slide explains how to find two different types of average return. So there are, these are arithmetic average return and geometric average return. So arithmetic average return is a simple average return. So return earned in an average period over multiple periods. So just you simply add all the returns, previous returns, and divide by number of returns. It's a simple average return that's called arithmetic average return. But the simple average return, like arithmetic average return, it doesn't consider compounding. So we have another average return. So another way to find an average return is to consider compounding. So average compound return per period over multiple periods, that's the definition of geometric average return. So geometric average return is always smaller than arithmetic average return. Unless everything is equal, if that's the case, geometric average and arithmetic average return will be the same. But in the real world, when we are looking at risky investments, for example, if you wanna, if we take a look at 12 monthly return for 12 months, every month the return will be different. So in that case, geometric average return is always lower than arithmetic average return because it's based on compounding. So which one is better? If you ask me, this slide provides the answer. So for a very long period, when you plan for a very long period like retirement account, then you definitely need to consider compounding. So for a very long period of time, geometric average return. But for a reasonably short period of time, so according to this slide, up to 20 years, it's okay to use arithmetic average return. But beyond that, geometric average return may be better. So it depends. So in short, depends on the purposes and uses. You may need to choose carefully between arithmetic average and geometric average, but it's good to know how to calculate both. So let's use a numerical example. So we have three numbers: annual return for 3 years. So year one return on this investment, it was 5%. Year two, lost to 3%, so negative 3%. Year three, 12%. So what's the arithmetic average return? That's a simple average. Arithmetic average return can be calculated by adding all those three annual returns and divided by 3 years. So 4.67% per year. So that's the average arithmetic. That's the arithmetic average return during this 3-year period. So it's on average, this asset earned 4.6% per year. So that's the meaning. And similarly, how to calculate the geometric average return. And remember, what's the difference between geometric average return and arithmetic average return? Geometric average return considers compounding, so interest on interest. So simply speaking, $1 growing at 5%. So what's next? So $1 growing at 5%, considering compounding. So how do you, what's the future value? So to calculate future value, you multiply $1 by 1 plus the interest rate, 5% in this case. And then after the second year, what happens to this future value? It keeps growing at the second year rate, right? So 1 plus negative 3%. So that becomes 1 minus 3%. And what happens next? You need to multiply the second year value by 1 plus the third year return, 12%. So that's the, so what's my point is, what's inside the square bracket is the $1 future value after 3 years. And then, but we want to find average return, not 3-year period. So that's why we need to take a scale, take this future value to the power of 1/3, because we need to find 1-year return, not 3 years. So that's the meaning of geometric average return based on compounding. And then what? You need to subtract $1 because it was the principal. So geometric average return, you calculate it this way, you get 0.0449, so which is 4.49%. So per year, this risky investment earned 4.49% geometric average return per year during these 3 years. So you see, arithmetic, when you compare the arithmetic average return and geometric average return is a compound, based on compounding, so it's always lower than arithmetic average return because these three numbers are different. So when we see some volatility in returns, geometric average return based on compounding is always lower than arithmetic average return. So you should be able to calculate geometric average return and arithmetic average return when you are given historical returns. Any questions so far? So you need to practice using numbers. Okay, so that's why you are given, you have a connect homework problem set in addition to this numerical example in the slide. All right, so if you don't have any questions, let's move on. So the remaining slides are about some concepts related to these calculations. So there is this is a very famous hypothesis in the financial market that helps us understand financial markets like stock markets in the real world. So according to this hypothesis, in an efficient capital market, if financial markets are efficient, securities prices reflect all the available information. But remember, this is a hypothesis. I'm not talking about the fact. Financial markets in the real world, the stock markets in the real world may be or may not be efficient. But this slide teaches you if the stock market we are observing is efficient, That means stock prices reflect all the available information. So that means, in other words, stock prices are in equilibrium. So when new information arrives at the stock markets instantaneously respond to this information and accurately process the information, and all the available information is reflected on the stock price. So stock price is changed quickly based on the new information, and everything becomes fairly valued if stock markets are efficient. So this is why this is a theory helping investors understand the stock market's movement, but it can be true, cannot be true. So there are different possibilities, but this is a concept that helps managers as well as investors understand what's going on in the stock market. So this is a concept, important concept, helps managers and investors make good decisions. So it's very important for you to understand this concept, this hypothesis. So in an efficient stock market, stocks are fairly valued, no mispricing. There's always risk-return trade-off, correctly, accurately reflected on the valuation of stocks if the stock market is efficient. So that's the concept. You learn this. So if this is true, that means if the stock market is efficient, then you should not be able to earn abnormal or excess returns. So what investors earn on efficient capital market is a risk-adjusted return. The return that's compensating for the risk, not abnormal return. So because everything is fairly valued in an efficient stock market. And common misconceptions about efficient market is if people think this next point explains, warns you against the misunderstanding of this concept. So efficient markets do not imply that investors cannot earn a positive return in the stock market. Of course, in an efficient capital market, investors will earn a positive return. And what kind of return would investors earn in an efficient capital market? Do all investors earn the same return in an efficient capital market because stocks are fairly valued there? No, I don't mean that. We don't mean that. In an efficient capital market, investors may earn all different returns. But those returns investors earn will be based on the risk they are willing to take, not more, not less. So fair returns. So efficient markets do not imply that investors cannot earn a positive return in the stock market. Investors may earn positive returns, and that returns will be based on the level of risk they will take in an efficient capital market. And another common, let's move forward. So in an efficient capital market, what's gonna happen to a stock price when new information arrives at the stock market? So suppose you have been analyzing stock A for a while, and there has not been many exciting news about. So just the business was as usual. So there was no stock price didn't change much during the past several days. But today, when right after the market was open, there was a news that company B decided to acquire company A's large premium. So it's a very good news for company A stock. And then if that's the case, if the company A stock, the stock market is efficient, what should be the reaction, market reaction to this news? When the news was announced, so time zero is the event time, when there was a good news arriving at the stock market, if the financial market, the stock market is efficient, the stock price should jump. So immediately jump to the right price. So that's new high price, that's the fair value based on the good news, the acquisition news. So in an efficient capital market, stock price will jump and then stay the same. But if the stock market is not efficient, people may overreact, and later, after several days, and realize, oh, it was I was too excited. The stock price should not be that high. So going back to the lower level, moving back to the lower level, that's not an efficient market. And how about this? People heard about the acquisition, but was not too sure about this, the impact, and then slowly react. And then the word spread out and it took several days, over a week, for the stock price moves gradually to reach the right price. So if that's the case, this kind of delayed reaction, that's not what's happening in an efficient market. So as soon as good news arrived at the stock market, the stock price adjusts instantaneously to the correct level. So if that's the case, so this kind of quick response and accurate response is what's happening in an efficient capital market. So this is a theoretical chart, conceptually explained what happens to stock prices in an efficient capital market. Any questions? Okay. So you may wonder, wow, it's great if stock prices reflect all available information, instantaneously. So whenever good or bad news arrives at the stock market, stock prices adjust instantaneously and stock prices become fair. So that's great for investors, right? So if stock market is efficient, we don't have to worry about, oh, am I paying too much for this stock? Is this fairly valued or is it overvalued? So for example, you see Amazon stock price went up sharply during this pandemic, right after the pandemic started. The people ordered, a lot more people are ordering online, and the biggest player in the digital economy, Amazon, and Amazon, Facebook, those kind of companies, stock price went up sharply. So if the stock market is efficient, the high stock prices we are looking at, those are fair values. Then we don't have to worry about, oh, am I paying too much? And that if markets are the stock market is efficient, investors feel more comfortable about buying and selling the stocks. But again, this is a concept. I'm not saying the stock market we are observing now is efficient or not. This is actually a $1 trillion question. So this efficient market hypothesis concept is like 40, 50 years old, this theory. And people, financial economists have a lot, and also analysts have debated a lot. And there are still many disagreements because of that disagreements, investing in the stock market, it's challenging as well as interesting. So there are a lot more stories behind this theory. So those who will take more advanced level finance courses will learn a lot more about this, but at least in this class, you learn this basic concepts and theories to fulfill the goal of, to meet the goal of finding the right discount rate for a new project in the corporate finance class. Yeah, good question, Mengting. So how do we know the market is working, the current stock market is efficient or not? So there are many testing methods. If there is a one good testing method, there will be no disagreement and everybody would agree. But unfortunately, testing method has some limitations. But a simple test is going back to this chart I show you. So there have been many news acquisitions in the past. So if we take a look at the acquisitions, what happened to the stock prices after the acquisition news? Did the stock price adjust sharply, or was there a delayed reaction or overreaction? So that's one way of testing the efficient market hypothesis. And also some other, how did fund managers perform? So did the fund managers, do we find the fund managers who consistently outperform the index? That means fund managers, those fund managers have skills. So if we find fund managers having skills, that means stock prices may not reflect all available information. So there are many ways of testing whether the stock market is efficient or not. So those kind of details and more interesting stories will be taught in Finance 3330 investment class. So if after you, you are welcome. So after you successfully pass this Finance 3310, you meet the prerequisite requirement for Finance 3330 investment. And there you will learn a lot more interesting stories about the stock market. All right. So it's a very challenging task to make stock prices reflect all available information. So this slide explains what's the driving force to make stock prices reflect all of available information. So in other words, what's the driving force behind making the stock market becomes efficient? If you ask me to answer this question using one word, my answer is competition. So there are a lot of investors around the world looking at the US stock market, try to find undervalued stocks. So that kind of competition among a lot of sophisticated investors, hedge fund managers, analysts, those people's competition, sophisticated investors, analysis and competition, that's the driving force behind the efficiency. So there are many investors out there doing research. So as new information comes to the market, this information is analyzed and trades are made. So if they just fast movers, knowledgeable analysts believe that this specific stock is undervalued. So those investors just submit a buy order, and that will make a stock price will go up to the fair value. So based on this analysis and information. So prices should reflect all available public information. It's illegal to use insider private information. So stock prices should reflect at least publicly available information in an efficient capital market. But insider information, private information may not be reflected in the stock price. in the real world because insider trading is illegal. So again, so in other words, this insider trading issue, legal issues, that also related to this efficient market hypothesis, this concept. So if investors stop researching stocks, then the stock market will not be efficient. So in other words, so some of you, among finance students, some of you maybe interested in becoming an analyst in the stock market, and those students should be very proud. So the analyst's hard work contributes to making the stock market becomes more efficient, and having an efficient stock market helps a lot of people in the stock market. So we need the hardworking and smart analysts. Right? So any questions, comments so far? Right? Let's move on. Right. So this slide shows a common misconception about the efficient market hypothesis. And I warn you, this sounds like an interesting and easy concept, but it's not. Actually, it's a very efficient market. The efficient market hypothesis can be easily misunderstood. So a lot of people, actually I see during the past 10, 20 years, but while I have been teaching and using this efficient market hypothesis, I have observed many people misunderstood this hypothesis. So be careful. So common misconceptions are summarized in this slide. So efficient markets do not mean that you can't make money. Efficient market hypothesis means that investors earn risk-adjusted returns, fair returns, and there is no abnormal return. And investors earn returns based on the level of risk they take. So no exception. So that's the efficient market hypothesis. An efficient market hypothesis means that on average, you will earn a return that is appropriate for the risk you take, and there is not a bias in prices that can be exploited to earn excess returns, abnormal returns. And market efficiency will not protect you from wrong choices. Market efficiency will protect investors only if they make good choices by diversifying their portfolio. So if investors put all eggs in one basket, that means making poor choices, even an efficient capital market, investors will be in trouble. So efficient market hypothesis emphasized the importance of diversification. Why? Because in an efficient capital market, every stock is fairly valued in an efficient capital market. So there is no reason to pick a stock. Just construct a well-diversified portfolio and manage risk and remove firm-specific volatility by diversification and earn expected return on a well-diversified portfolio based on the level of risk in the diversified portfolio. So that's what the efficient market hypothesis suggests. But if the stock market is not efficient, then there may be an undervalued stock, there is a bargain, then there is no reason for diversifying. Just pick the bargain stock, and when the stock price returns to the fair value and earn a high return. So don't diversify if that's the case. So if investors believe in efficient market hypothesis, they will not concentrate on specific stocks. They will construct a well-diversified portfolio because they think all the stocks in the market are fairly valued, but if investors don't support the efficient market hypothesis and they believe the possibility of undervalued stocks, it's not too difficult. If they believe, if it's not too difficult to find undervalued stocks, and they may concentrate and may put all eggs in one basket, and if they are lucky, they will earn higher return than the overall market. And then, so this is a very important question. If the efficient market hypothesis, whether investors support that hypothesis or not, will affect their investment decisions, right? So any questions, comments so far? No? And then let's move on. And the remaining slide explains 3 different levels of efficiency. The strong form efficiency, as the name explains, it's the strongest form. So we have 3 forms of efficiency. The strong form efficiency requires that stock prices reflect all information, whether publicly available information or very private information. Only top management of the company knows. Even that kind of very private and insider information, all those information should be reflected on the stock price. If that's the belief, that means this is the strong form efficient market hypothesis. So if the stock market is strong form efficient, then even insiders with private information cannot earn abnormal return. But this is strong form efficiency. Again, this is not a fact. This is a hypothesis. But we can easily tell that, oh, this hypothesis, that's not consistent with what's going on in the real world. Because if the stock market is strong form efficient, why SEC regulates insider trading? So insider trading is prohibited. That means that there is a possibility that insider private information may be useful for finding undervalued stocks or overvalued stocks. So empirical evidence based on the stock market history indicates that markets are not strong form efficient. So insiders may earn abnormal returns above and beyond the risk level of that stock. So this is in the real world, financial markets show that markets are not strong form efficient. Empirical evidence suggests that. But this slide teaches you not the fact. Again, this is a concept. So strong form efficient market hypothesis. What's the concept? That's what you need to learn using this slide. So any questions? And let's move on to the next one. So the next level, semi-strong form efficiency. Then that's a less strong form. So semi-strong form efficient market hypothesis means that stock prices reflect all publicly available information, including anything anything publicly available, like 10K financial statements, or what you read in the newspaper, or the company's CEO's interview. So or what was the stock price yesterday? So historical prices. So all any information that's publicly available. If any information that's publicly available, all of them are reflected on the stock price accurately, instantaneously. If that's the case, the stock market is semi-strong form efficient. So if the stock market is semi-strong form efficient, investors cannot earn abnormal returns by trading based on analyzing public information. So there are analysts out there, CFAs, for example, using all publicly available information. So that kind of analysis has a name. We call it fundamental analysis. So fundamental analysis that uses publicly available information to pick stocks. That fundamental analysis will not help generating abnormal returns if financial markets are strong form efficient, semi-strong form efficient. So semi-strong form efficiency, if a stock market is semi-strong form efficient, fundamental analysis analysts do will not lead to abnormal returns. So you can, so from this knowledge, you can tell that, oh, analysts do not support the semi-strong form efficiency. If they do, they would not analyze stocks using public information to find undervalued stocks. So, but we see in the real world, there are many analysts, so that means there are disagreements about this semi-strong form efficiency. So those who avoid fundamental analysis, that means they support efficient semi-strong form efficiency. Those who do fundamental analysis, they believe the stock prices not always reflect stock prices do not always reflect all publicly available information. That means those who do fundamental analysis, they do not fully support the semi-strong form efficiency. So again, this is not a fact. So this is a hypothesis. Some people support it, other people do not support it. But interesting thing is, all those investors compete in the same stock market. So whether you support this hypothesis or not, understanding what it is and understanding how many people support it, how many are not supporting it, knowing that is important when you make an investment decision, whether you are supporting this hypothesis or not. That's why you learn this. So we require you to learn this important concept. Any questions? All right. The last form, weak form efficiency, means this, the weak form efficient market hypothesis tells you that stock prices reflect all past market information, like previous price of the stock and previous trading volume of the stock. So not necessarily earnings call transcript or financial statements. That kind of data is not included in this information set. So those who support the weak form efficient market hypothesis tells that stock prices at least reflect that kind of historical price and trading volume. That kind of market data should be reflected on the stock price. So that's the weak form efficient market hypothesis. So if the market is weak form efficient, then investors cannot earn abnormal return by trading on this market information like previous price and volume. So this kind of analysis based on previous price and volume has a name. So that's called the technical analysis. So if the stock market is weak form, at least weak form efficient, technical analysis will not generate abnormal returns. And what's the test result? So empirical evidence indicates that markets are generally weak form efficient, but it's generally, but there can be exceptions. So that's why there are technical analysts in the market out there, some very successful ones as well. So again, this is a hypothesis. It's not a fact. So weak form efficiency may be violated. So, for example, have you heard of the resistance level of this stock or moving average, resistance level, supporting level? And that's a good example of a technical analysis. So technical analysts use the term, oh, moving average stock price of this stock is $97 during the past 200 trading days. But this stock is only 70, but moving average is 97. So I'm going to buy this. Sounds like a bargain. So if you hear someone says, talking about the moving average, resistance level, that kind of terms, you can tell that, oh, that person is a technical analyst. So that means that person does not support the weak form efficient market hypothesis. All right. So we finished this. Okay. We finished chapter 12. So just before we move on, let me ask you one question to make sure that you are understanding what's going on. If financial market is semi-strong form efficient, it is also weak form efficient. Is it true or false? If a financial market is semi-strong form efficient, it is also weak form efficient. So let me write it down. Yeah. Whiteboard. True or false? True or false? If a stock market is semi-strong form efficient, it is also weak form efficient. True or false? So think about the answer while I take attendance. So I will stop share and then I will take a screenshot. And I will take the screenshot for the second page. Okay, I'm done with taking the screenshot. All right, so what do you think? All right, I see the movement. Yeah, I see true and false. Yeah, the correct answer is true. So this is a true statement. If a stock market is semi-strong form efficient, that means that all information that's publicly available already reflected on the stock price. So that means that kind of all publicly available information includes market information, previous stock prices and trading volume data. So automatically, the stock market becomes also weak form efficient. So this is true. So this is true. This is true. All right. But what if the other way around? So if a stock market is weak form efficient, if a stock market is weak form efficient, it is also semi-strong efficient. Is it true or false? Yeah, I see a movement in the chat box. Yes, this is false. Good job, Jackie. So this is just false. So this statement. Oops, this statement. So this statement is false. This statement is false because if a stock market is weak form efficient, that means the stock prices reflect all market related information, previous prices and trading volumes, but that does not necessarily mean that P ratio or 10K report, that kind of other publicly available information reflected on the stock price. That's not necessarily the case because weak form efficiency doesn't tell about other publicly available information. So semi-strong form efficiency may be violated. So that's why this statement is false. All right. So any questions so far? All right. Then keep working on this chapter 12 questions, and your homework is due by Wednesday night, so don't miss the deadline. So submit your answers to the homework, connect homework, so don't miss the deadline. So chapter 12 homeworks will due soon. Yeah, you're welcome. So let's move on to the next chapter, chapter 13. So chapter 13, I need to warn you, chapter 13 has a lot of complicated calculations, analytically very challenging, and many students struggled. Especially those who didn't practice enough. So I warn you, chapter 13 is very long and complicated. It takes a lot of time to study. So you need to allocate enough time to study and plan ahead to do the homework. So chapter 13 is one of the most important chapters for the final exam. So you need to allocate enough time to study. But once you, good news is once you practice enough, learn enough, and then all the questions will be very straightforward, not very controversial, very straightforward, and it's not too difficult to answer to those who allocated enough time to study. So plan ahead and be careful. So that's why I emphasize the importance of studying this chapter 13. Yeah, you're welcome. All right, in chapter 13, this is the main chapter. Chapter 13, in short, shows you the relationship between the right discount rate and a risk measure. So this, to get there, there are many complicated calculations. So you need to overcome that hurdle. So I'm gonna help you. And on Wednesday, we don't have a class, you know that, right? So Wednesday is Friday, according to the Brooklyn College's academic calendar. So we don't have a class this Wednesday. So that means until the next class, you have 1 week. Of course, happy Thanksgiving. So you're gonna have a holiday. We are gonna have a holiday, but unfortunately this year, we are not gonna have a lot of large gathering. That's we need to avoid. So that means we celebrate in a small group or with just a family in the same household, and that means we have less huddle for other things. So hopefully during this long weekend, you have some time to catch up with some courses and materials you need to. So those who can do that will have the end of the semester, that kind of a challenge will be less. So hopefully, so chapter 13, so let's see. Let me admit this. Yeah, happy Thanksgiving. You too, everyone. Okay, so in chapter 13, all right, so in chapter 13, what you need to pay attention to is how to calculate the expected return, variance, and standard deviation. The calculation will be important, but you may wonder, oh, we already learned it, how to calculate standard deviation, expected return, variance. But what you learned in chapter 12 is how to use historical return data to calculate expected return, standard deviation, and variance. But you didn't learn how to do this calculation when probabilities are given. So there will be a new calculation. And this chapter emphasizes the impact of diversification. And you are going to learn the difference between systematic risk and firm-specific risk. You may wonder, oh, what is systematic risk? You will learn it soon. And you will learn about the security market line that shows the relationship between the systematic risk measure beta and expected return. That we will use to find the right discount rate. And this discussion will complete our discussion about the risk-return trade-off. Yeah, no class on Wednesday. Yeah, no class on Wednesday. Our next class will be Monday. Yes, all right. So class outline. So in this chapter, you're going to learn expected return and variance, standard deviation calculations, and we will talk about portfolios of stocks and what's the impact of announcements and what do we mean by surprises in the stock market and systematic risk versus unsystematic risk, and the importance of diversification and how to measure systematic risk using beta, and what's the security market line, and that helps you to find the right discount rate for the risk level of a project or a stock. So expected returns are about the future. So what kind of returns investors are expecting to earn in the future? So by definition, expected returns are for risky investments. So risky investments means there is some probability of a high return as well as some probability of low returns. So we need to use probabilities of each possible outcome. So expected returns are based on the probabilities of possible outcomes. So in this context, expected means average if the process repeats several times, many times. So that's why we are using probability distribution. So, but expected return does not have to be a possible return. So that's like an expected return is the average when this random event repeats many times. So this equation shows how to use probability of each return to calculate expected return. So this equation is for each of the possible return multiplied by probability of each possible return and add it all, that's the expected return. So this equation helps you to calculate expected return when probabilities are given. Right? So here is a numerical example. So stock C and stock T. if next year, if we overcome the COVID-19 crisis because of successful vaccine development, and the vaccines will not have any significant negative side effects, so a lot of people get vaccinated, and then economy returns to the normal. If that's the case, stock C return will be 15% next year. Wow, that's great. So and how likely is that? If the probability is 30%, so there will be an economic boom. But what if we don't have that kind of huge boom, but the economy will slowly return to normal, so the economy will be reasonably good? If that's the case, the stock C return will be 10%. What's the probability of that kind of normal economy? 50%. But what if? I hope not, but there is a possibility that the vaccine does not work, or vaccine, there is a new variant, so some other bad situation happened. So if that's the case, the stock C return will be 2%. So similarly, we have that kind of analysis for stock T. And I have a question mark here. So in this kind of bad scenario, recession scenario, what's the probability? So what should go to this blank? Because if there are only 3 possible states, so I see a movement in the chat box. Yeah, 0.2. Yes, 0.2. Good job, Jackie and Aisha and Julian. So thanks for your participation. This 0.2 should go there. The question mark should be replaced by 0.2 because 30% probability, 50% probability, and 20% probability. In other words, probabilities should add up to 100%. So if there are only 3 possible states, the remaining probability will be 100% minus 50% and 30%, so 20%. 0.2 is the probability. So if I ask you to calculate what is the expected return on stock C based on this data, so how are you going to calculate expected return? So use this equation. So expected return of a stock is probability of each state multiplied by return on that stock in each state, and do the calculation for all the 3 states and add them all. So that's the expected return. So if the expected return on stock C is 30% multiplied by 15% return plus 50% probability multiplied by 10% return plus 20% probability multiplied by 2% return. So 0.099, that means 9.9% is the expected return on stock C. Any questions? So I have 2 points to make here. I strongly recommend you to use decimal in the middle calculations and convert your final answer to percentage. So that's the best way. But if you really want to use percentage in the middle calculations, go ahead, but be extra careful not to mix with the decimal. If that's the case, you can easily make mistakes. So I strongly recommend you use decimal in all the calculations, and then your final answer, convert it to percentage. That's one point, important point. Another important point is, look at this expected return. So expected return on stock C is 9.9%. So that's not even a possible return in those scenarios. So that's the point I made in here. Expected return does not even have to be a possible return. So expected return and possible returns are different. And if I ask you to calculate the expected return on stock T, what are you going to do? You do the same. So my recommendation is don't look at my answer and do the calculation. Expected return on stock T. What should I do? Oh, probability, 30% probability multiplied by 25% return in that state, and do the same for all other states and add them all. So 17%, 7% is the expected return on stock T. So any questions so far? All right, if you don't have any questions, I'll ask you this question. If the risk-free rate is 3%, what is the risk premium on stock T? So this tests you whether you are remembering the term risk premium. So what was the definition of the risk premium? So the definition of the risk premium is expected return on risky asset minus risk-free rate. So that's the definition. So the risk premium on stock T is 14.7%, which is 17.7% expected return minus 3%. So the answer to this question is 14.7%. So what about if I ask you what's the risk premium on stock C? The answer is 6.9%. Because 9.9% minus 3% risk-free rate is the risk premium on stock C. So stock C has a risk premium of 6.9%. And stock T has a risk premium of 14.7%. Why? Because stock T is riskier. Stock T's return has a higher variability. Volatility is higher. So that's why expected return is higher. That means we apply higher discount rate to do the stock valuation. For stock T, that means stock price will be lower, because we will apply higher discount rate. So any questions so far? No? And let's go on, then let's move forward. So by just looking at those possible returns, we can easily tell that stock T looks more volatile, so has a higher risk. So how can we measure the risk of stock T using this data? Oh, if you remember correctly from the previous chapter, we can calculate the standard deviation. So we can use the standard deviation of stock T return to show that stock T has a higher standard deviation than stock C. So stock T is riskier. So that's why we will calculate standard deviation. But to calculate standard deviation, you need to calculate variance first. So variance and standard deviation measure the volatility of returns. So you need to use probabilities for this calculation. So when we are looking at three possible states, economic boom, normal, and recession, those probabilities were different. So we are not just gonna use the deviation from the mean squared equally. So we are gonna use probability to weight the deviation from the mean. So we first calculate expected return for stock C and stock T, and for each of the three possible states, boom, normal, and recession, we calculate the return, possible return, and expected return, deviation from that expected return, and square it and multiply by probability and add them all. So that's variance. And take a square root That's a standard deviation. And remember, you saw a similar equation in the previous chapter, right? When you use historical return data. There, what did we do? We didn't have a probability, and we did the calculation, and we divided by n minus 1. That means all the deviation from the mean was equally weighted by n minus 1, 1 over n minus 1. Because when we are using historical return data, we just used all the historical return observation. We treated them equally. But here, when we have probabilities, we don't treat economic boom, normal, and recession scenarios equally because we obviously see different probabilities. So we use different probabilities for each state to give different weights for this dv squared deviation. So the concept and equations you learned in the previous chapter using historical return data are related to this new equations for the scenarios, but they are not exactly the same. So, but in the past, when I saw students work on problems, if they didn't practice enough historical and probability of approaches, just mixed up and easily make mistakes. So that's why to avoid that, you need to practice with many different types of examples to make sure that you can apply the right formula to the right situation. So let's use this equation and practice using the numerical examples. So for the same data I gave you for the stock C and stock T, if I ask you to calculate standard deviation, what you need to do is this. This slide shows how to calculate standard deviation for stock C and stock T. So let's take a closer look. So what should we do first? We should calculate the variance first. So how? We've calculated that expected return is 9.9%. And remember, always use decimal when you do the middle calculations. So 9.9% means 0.099. How far away is it from the economic boom? So stock return during an economic boom. So 15% minus 9.9% square. So square the deviation from the mean, multiply by what? Probability 30%. And do the same for all those three scenarios and add them all, that's variance, and take a square root, that's 0.045, and convert it to decimal, 4.5%. So that's the standard deviation of stock C. You do the same for stock T, and you find 8.63% is the standard deviation of stock T. So indeed, the stock T has a higher risk measured by the standard deviation. So this is how to calculate the standard deviation of a stock. Any questions? So you should practice. So start chapter 13, practice problems right away if you have not done so already. I saw many students already started. Thank you. So if you are one of them, so keep going. But if you haven't started chapter 13 problem set, you should start immediately and start practicing. So we only have 4 minutes remaining. So to help you study this chapter during the period until you see me next Monday, I'll use the remaining 3 minutes just to quickly show you what's remaining. So in the next slide, we will talk about portfolios. So usually when investors invest in the stock market, they construct a portfolio, many stocks. So you should learn how to analyze a portfolio. So first you need to learn how to calculate portfolio weights. And weights are based on dollar amounts invested in each stock divided by the total dollar amounts invested in the portfolio. So we use portfolio weights and calculate portfolio expected return. Good news. Portfolio return is always weighted average return of individual stocks in the portfolio. So portfolio return is always weighted average. And what's the weight? So weights are based on the dollar amount of invested in each stock divided by total dollar amount of the portfolio. So if you are asked to calculate the portfolio expected return and standard deviation first, calculate the portfolio return first. So portfolio return first for each scenario and use this portfolio return to calculate the expected return and standard deviation. Just the same equation you used to calculate the expected return and standard deviation. So in short, if you are asked to calculate the portfolio expected return and standard deviation, first, calculate portfolio return for each state and apply the standard deviation and variance equation to calculate the portfolio expected return and standard deviation. So after you master how to calculate portfolio expected return and standard deviation, we are going to talk about expected return and unexpected return and what's the impact of news on stock value. And we will talk about the efficient market hypothesis using this new knowledge you gain. So in other words, the efficient market hypothesis you learned in chapter 12, we will come back in chapter 13, and we will talk about standard deviation. Measuring total risk has two components: systematic risk, market risk that cannot be diversified away, and unsystematic risk that can be removed by diversification. So taking risk will be rewarded in an efficient capital market as a risk premium, but taking risk unnecessarily will not be rewarded. So that's why there is a trade-off between expected return and so total risk has two components: systematic risk and unsystematic risk. And unsystematic risk can be easily removed by diversification. So only systematic risk will be rewarded. So that's why we emphasize diversification. And there is a reward for bearing risk, but there is not a reward for bearing risk unnecessarily. So remove unnecessary risk by diversification, and there will be a reward for taking systematic risk that cannot be removed by diversification. And we use beta to measure the systematic risk component. And we do some exercises and we see the relationship between beta, systematic risk measure, and expected return. And there is an asset pricing model that shows the relationship between a systematic risk measure beta and expected return. That's how you can find the right discount rate. So as long as we can find the beta of a risky investment, we can find the right discount rate. So that will conclude this chapter. So have a happy Thanksgiving, and I will see you Monday next week. And don't forget about the Connect homeworks. Meet the deadline, so don't complete the homeworks on time, plan ahead. So if you have any questions, you can stay and ask or start writing it on the chat box. Otherwise, I will see you next week. Bye, everyone.